Good afternoon. I'm Anna Nichols. I'm the Director of Communications at Altair Advisors. Welcome to the 2023 Investment Forum. We have a very full room today. We're very excited about that, and thank you for coming out to be with us. Most people know us today as our audience is primarily Altair clients. But for those of you who are guests today, Altair is a private, independent wealth advisory firm. We provide investment management, financial planning, and client education services to a select group of individuals, families, foundations, and endowments. Our tagline is Wealth Guidance for Life, and we use that because we believe that the clients we work with make decisions on their wealth based on what they would like it to do in their own life and provide in the lives of their family members. Our role is really to provide clients with the investment oversight and the financial guidance to help make those goals achievable. And programs like this are actually an extension of some of the customized work that we do for clients. This is an opportunity for us to bring our client group together. And today's program, we're actually going to record it because we do have a lot of people that called and said, I can't be there, but I'd like the recording. So it will be recorded. We won't have you on video, but we will be recording the stage today. And we're going to cover two main topics. We're going to start off with Jason Laurie, our Chief Investment Officer, who's going to give us a market update. And he's going to review the major economic factors sharing the financial markets and the global economy. And after that, we're going to have two sessions centered on artificial intelligence. In the first, Christian Hammond, a professor of computer science at Northwestern University and co-founder of the artificial intelligence company Narrative Science, will give us an overview of the implications of AI. And after a short break, David Lynn, Altair's head of research, will lead a discussion with Anthony Zachary and Lee Marie Braswell, expert representatives from two of the managers that we work with on public and private investment opportunities in AI. We're going to save time for Q&A at the end of both AI sessions. We know there's a lot of questions on this topic. We encourage you to ask those questions. We'd like this to be as interactive as possible. There'll be two of us with microphones that will go around to try and get to you with your question, but we'll make sure we can all hear those. If we don't, for some reason, get to your question today, if we run out of time, we'll be here at the reception, and we can also follow up with you after the program. A few quick housekeeping notes. We're going to be taking a break at 3:30 p.m., and if you need them, restrooms are downstairs on the first floor. And also, if you valet park today, you can get a voucher for that parking just outside the door at our front registration desk. And finally, we are hosting a reception once the program's over, and we hope that you can join us for that. It'll be right next door. So with that said, I'm now going to turn things over to my colleague, Altair's Chief Investment Officer, Jason Laurie.
Thanks, Anna. Let's see here. Oops, not on. There we go. Thanks, Anna. As Anna said, my name is Jason Laurie, Chief Investment Officer here at Altair Advisors. And I'm going to start with a market overview and then hand it off to the next two sections to focus really in on artificial intelligence. And when we kind of sit down and decide what is going to be the area of focus on the forums, we kind of think about it in really three buckets. What is moving markets today, what we think is going to move markets in the future, and then what kind of questions are we getting from our clients. And last year when we sat down to do the meeting, it was a pretty short meeting because it was going to be interest rates in the Fed. And for those that attended the program, that's really what it was all about, is interest rates in the Fed. And although that topic is still very important, and I've dedicated a few slides to it, we're at the cusp where the market's starting to look beyond at the next, what's going to move markets in the future. Earnings is sort of a more near term, and then longer term artificial intelligence. But as you'll see in a minute, artificial intelligence is actually moving the market today. So with that, I'll start with a quick year in review. And so as many of you know, each quarter Altair commissions a cartoon. And the objective of the cartoon is to capture the main events of the quarter that is moving markets. The second objective, which is far down on the list, and sometimes we don't exceed, is actually be funny, and that doesn't always happen. So first quarter, the cartoon was the regional banking crisis. And how many people walk around or remember that in 2023, we've had 3 of the 5 largest bank failures in history? We're kind of already forgot about it. But our slide here was the government with the Fed with Jay Powell, the Treasury with Janet Yellen, and then probably a lesser-known character, chairman of the FDIC, with Martin Gruenberg. And of course, when you have a failed bank, the FDIC takes that over. So the first quarter, that really was what was moving markets, and that end of the first quarter in March was really kind of what that was all about. And they were able to stabilize the regional banks. There's no question about it. That's why we're not talking about it as much. But the damage that was done during that crisis, it still exists today. And I have a slide or 2 on that. And if you look at the regional bank index, it's still down 30% year to date. So stable, yes, certainly not back. Second quarter, it was all about the topic that we are going to talk about today, which is artificial intelligence. And it was all the enthusiasm over AI and ChatGPT that had come out at the end of last year. And it was dubbed the Magnificent Seven, and that after the 1960s Western. And the concept here is the market was trying to pick or front-run the winners of the beneficiaries, or at least near-term beneficiaries of artificial intelligence. And really, the winners it was picking was the largest of the large tech stocks. And by the way, it's not just tech stocks, it's the largest stocks in the US, in the S&P 500. So we got Amazon, Apple, Meta, NVIDIA, Tesla, Google, and Microsoft. And what you'll see in a minute in my slide is even through today as we stand here, pretty much all the return in the stock market this year has come from these 7 stocks. So again, as I say, when we were selecting the topic, it's not just about this far-off future artificial intelligence theme, it's having an effect on markets today. Then our last cartoon, which we just released about 2 weeks ago, is on the consumer. And it is a play off the 80s arcade game Donkey Kong. And of course, only us Gen Xers could think of this, David and I. If you remember what's going on here is Mario is trying to make his way up the steel girders, and Donkey Kong is throwing all these things at him. And the reason why we put this here is because we think it's one of the linchpins as to whether we're going to avoid a recession. We're not in a recession. You'll see in a minute a lot of people thought we were going to be in a recession, but we're not. And the reason we're not in a recession is because the consumer has powered the economy. They have not flinched or blinked. And that really is the reason why we're not in a recession. And so the question is, how long can Mario last getting these barrels thrown at him? And you'll see in a second, there's certainly pressures are building, but it's not yet at the forefront. So let's take a second and check in on how markets of the major asset classes are doing year to date. This is as of 10/31, so end of October. We went to print at the end of October, and who would have guessed that the last 5 trading days were the best 5 trading days in 10 years, but we went to print. What you can kind of see is that really all the return is up here in large cap at 10, 11%. And more specifically, as I hinted at before, all of it's really coming in large cap growth. And by the way, if I would run this as of yesterday's close, the S&P would be up 15, not 10 or 11. And really, what you're going to see is pretty much all the other major asset classes, I think it's fair to say, ho-hum at best. And these are the asset classes. These are not any one manager. And including our bonds. We're on the verge of having a 3rd year of negative returns in bonds. So that is a historic if that's how it ends this year. So again, all of these are about 5% higher. As I said or hinted at before, pretty much all of that return in the S&P 500, the large cap growth, is coming from those 7 stocks. It's really kind of amazing. If you look at that 10% number, see if I can get it here. It just conked out on me. There we go. If you look at the constituent parts of the S&P 500, so there's believe it or not, there's 503 stocks in the S&P 500. You'd think there'd be a rule not to have more than 500, but there's not. And it turns out that the top 7, Microsoft, NVIDIA, Apple, Amazon, are accounting for basically all of the return of that 10, 11% that's now 15. And if you take the 496, it's basically flat. Not every stock, but on average is flat. So when we talk about a topic that's not just this far-off future topic that's really moving markets today, that belief that euphoria over artificial intelligence is certainly moving some of these big tech players already. Probably front-running it, but still moving it. But the next 2 sessions are going to sort of broaden out more than just these magnificent 7 and talk far more about all the implications. And we're going to bombard you today with headlines. Here's my headline slide, but there's more coming, I promise. And the basic concepts, I pulled headlines in the last 3 months. 1, we're at the early innings of artificial intelligence. 2 is regulation. And it's not just heating up, but the Biden administration already issued a 111-page executive order on the topic. I'm not sure people actually know what it says or does yet, but we're there. And then, of course, what David and his panel is going to talk a lot about is the opportunities, the investment opportunities. So we're going to move away from just talking about large cap growth, just talking about these 7 stocks, to a much broader topic in the next 2 sections. So backing up to kind of topics that are moving the markets or of concern, both positive, I should say, and negative. So the first is, for obvious reasons, we needed to check in on geopolitical events. And one of the things that we put together, we actually updated this slide. Unfortunately, we created the slide last year when Russia invaded Ukraine and re-updated it now when Hamas attacked Israel. And what you can see here is that if you take all of the geopolitical events, that's the gray line, going back to 1940, so 84 years, including 1940, what you kind of see this pattern is markets kind of get nervous, as you would expect, and fall. And then if you kind of go out to like the 6-month period, you see that you're almost pretty much back. And the punchline here is really, in general, geopolitical events on average really aren't moving the market long term. Market being defined as S&P 500. You can see where we're at with Hamas, Israel. Now, if I, again, updated this through yesterday, this now red line would be above 0. A lot of folks, though, are worried about not just the S&P 500, but oil, especially when you're talking about an area with oil producers. And what happens with oil and geopolitical events is sort of the reverse of what happens with the S&P 500. S&P 500 usually dips and then kind of comes back. Oil does the opposite. Anytime there's a geopolitical event, oil will pop. And then what you can see is it usually kind of comes back down to at or below where it was. And I think the biggest issue is that oil is just more a function of what's going on in the economy than it has anything to do with the geopolitical event. And again, if I would, yesterday was obviously the 1-month mark, and oil is below where it was on 10/7. And this is back through 1990, so 34 years. So I said that I haven't forgot about rates in the Fed and interest rates. So we are going to talk a little bit about what has happened in the bond market, and in particular with Treasury yields, because it certainly impacts pretty much all financial assets. In your deck inside there that we printed out, you have the final. This is sort of a build slide, so I'm going to make you dizzy here for a second. But what I wanted to focus on is we came into the year with a yield curve that looks just like this. So how a yield curve works is this is the short end, so these are 3-month treasuries, and these are, of course, the long end. And so 3-month treasury was yielding about 4.5 or 4.6, 4.7, and then the 7-year was at about 4. So we had an inverted yield curve. Front end was higher than the long end. That's not normal, but it is normal in a rate hiking campaign from the Fed. And as we go through each quarter, you'll kind of see what happens to the yield curve. Now, the Fed controls the front end of the yield curve. We came into the year with the Fed funds rate at 4.25. The Fed has raised rates by 1%, 0.254 times. The last time they did it was July. And what you'll notice in a second is the front end of the yield curve basically just follows what the Fed is doing. The Fed is raising, the front end will go up. When the Fed pauses, the front end of the yield curve will pause. So you can kind of see and focus just on the front end. I'm going to do this again on the long end, but on the front end, Fed raised rates. You can see the front end of the curve just kind of follows it. Fed raised rates again and then pause. This is the third or the fourth time, and then they paused. That was July, was their last raise. So now when we go to September, front end of the curve really didn't move because the Fed had paused. And the Fed was, in our view, done raising rates for this rate hike campaign. So that was the front end of the curve. So we still very much have an inverted yield curve. So I'm just going to back this up for a second. So we start here at the long end. Now the long end of the curve, the Federal Reserve does not control. But the long end of the curve is far more impacted by how the bond market views future economic growth. If it views that future economic growth is strong, this yield is going to go up. If it feels that it's weak, that yield is going to come back down. So we had the regional banking crisis, the cartoon I just showed you. Watch what happens to the long end. Right on cue, gets nervous, thinks it's going to be a recession. Future economic growth is going to be lower. Fed comes to the rescue and stabilizes the assets, takes over the banks. We pop back up. We kind of move beyond the recession scenario that dominated much of the year. And we kind of end the third quarter with a much higher long end rate. So what's happened this year? The front end of the curve has just followed the Fed, and now the long end of the curve is finally starting to catch up. So that would say the bond market believes that expected growth is higher than it did at the beginning of the year, and it would also say that they probably believe the Fed is done raising rates. Now we're going to talk in a minute about this big jump at the end of the third quarter to rates that we actually now feel are fairly attractive at that longer end. For the Altair clients in the room, which I know are most of you, you know in the taxable portion of your fixed income portfolio, we have been rolling short-term treasuries to kind of capture this upward trend for the last year or so. Can't talk about yields and the Treasury yield curve without talking about inflation. Certainly the topic last year that kind of sucked all the oxygen out of the room is inflation. Left-hand side is core CPI. And just as a reminder, core CPI, we strip out energy and food. And what you can, as opposed to headline, and what you can see is that we peaked out at about 6.6. Now, some people in the room may have 9.1 in their head. Well, that was the peak out at headline. But core is the 6.6. So we're on the right trend. It's coming down. It's not where the Fed wants it, which is around 2%, but it's on the right path. On the right-hand side, the team broke the core CPI into two parts. They divided it into goods, so apparel, vehicles, et cetera, manufactured goods, and services. And so what you notice by the chart is we've pretty much stripped inflation from the goods economy. However, the services, it's coming down, but it's pretty sticky. It's pretty sticky. And the reason for that is because services are the most impacted by wage inflation. We still have a very strong labor market. And That is really why the Fed is at the rate they're at right now. I mean, if it was all about goods inflation, the Fed would already be cutting a long time ago. But services is what's keeping it up there. And so as the labor market loosens up a little bit or actually gets a little worse, wage inflation will decrease and that services should follow. And by services, the biggest category in services is shelter, or really what they call rent equivalent, which is sort of an esoteric Fed term, but it just means their formula for what it would cost to rent your own house. I said a few minutes ago that I can't help myself when you can poke fun at the economists and when they told us all we were going to be in a recession, so here goes. The Wall Street Journal has conducted this survey of economists since 2006, so going back roughly 17 years, and I just kind of plotted here back to January 21. First off, let's talk about this gray line, which tells you that in any given year, 25% of the economists think we're going to be in a recession in the next 12 months. So the baseline is kind of 25%. You can sort of ignore that first 25%. And what you can see is almost exactly 1 year ago, 63% of economists said, right now, we should be in a recession. And we're, of course, not in a recession. And just to put this into context, this is a number we really only saw in 2008 and really that first few weeks of the dark days of COVID shutdown. So this is really an outlier figure, but they certainly have been very, very wrong as far as predicting the recession this year. I said it before, why are we not in a recession? Well, we're not in a recession because the consumer has just been very, very strong. They have been able to hop over all of Donkey Kong's obstacles. And this is just retail sales. We could put a number of slides up here, but what you can see is the chart keeps going up. The last reading was positive at 0.7%. Now, the consumer has been impacted by inflation, so that this does not mean that unit volume is increasing. It just means dollars are going higher. But certainly, the consumer has really held up this economy. Consumers can usually hold up the economy when when the job market is very strong. So I've picked a few slides here. One is just the initial jobless claims. I like this slide because it's very real time. We get it every Thursday morning. And what you can see is we've just been bouncing around this 200,000 mark every week, and that's very healthy, that's very normal. You'll read a lot about, well, the slope of the initial jobless claims and all this stuff. 200,000 or roughly is fine, it's healthy. That's not indicative of any kind of a recessionary environment. We still also have 1.5 job openings for every unemployed person. We peaked out at 2, so it's come down, but we still have far more openings than we do, or far more job openings than we do unemployed people. So that's why the wage growth is still under pressure. Of course, one of the major markers of a recession is GDP growth. If we have negative GDP growth, it's not the only marker. And you can see from this year, Q1, Q2, Q3, we certainly do not have negative growth. And in fact, the quarter that we just got, 3Q, was what we would call a blowout quarter at 4.9%. That was huge, and pretty much Atlanta Fed actually nailed that one, but it was pretty much the only group that nailed that high number. So again, far from a recession. The real-time indicator in Q4 is about 2%. Again, coming down. That 4.9 is not sustainable, but certainly not anything recessionary that the real-time indicators are telling us right now. As you probably remember from last year, we were in this negative 2 quarters, and it really was the hangover from the initial period of COVID. Again, that was never marked a recession, but it was certainly just the hangover of the goods economy actually sort of getting out of control. So that sounds like a lot of good news. So let's flip the page for a second. What are we concerned about? Well, what we're concerned about is that these obstacles keep coming and keep coming for longer. Higher rates for longer do impact the consumer. I don't think it's new news to anybody in this room, but mortgage rates are at highs over the last few decades, a 30-year mortgage approaching 8%. And over the COVID period, the consumer really built up this war chest of savings. We had fiscal and monetary policy, and if you have disposable income minus consumption, you had a lot left over because people were making more than they were consuming, so they had excess savings. Well, what you can see is consumers are dwindling that. They're eating into that. Now, this number is still historically high. This only goes back to 20, but it clearly is showing a trend that in order for consumers to keep spending, they are dwindling their savings. So certainly on the consumer side, this is what we're watching very closely, because if the consumer can keep up, we will avoid a recession, and you'll see in a minute, if the earnings, corporate earnings keep up, markets will do just fine. Let's turn to the business side. That was the consumer side. In my mind, this is probably the most bearish slide I have in the deck, which is credit and on the business side. So this is a senior loan officer survey. So they asked senior loan officers at banks, are you increasing your standards, tightening your standards, or decreasing? So it's pretty clear that everybody's increasing their standards, meaning that it's harder for businesses to get a loan today. And I know many of you run businesses or sit on boards, and you all know that to be very true, is that bankers are not doing the same thing they did 18, 24 months ago. And so that is probably on the business side, the most negative of the slide. So I would say, people always say, what are you watching on the negative slide? Business side, we're watching this. Consumer side, we're watching this. Now moving to probably the most positive slide in the deck, which is corporate earnings. This is going back to Q2 22. This is the change year over year in S&P 500 corporate earnings. We went through an earnings trough that's been kind of well publicized. We're right here smack dab on the Q3 earnings. We're about 85% through. And that's going to come out to be about 4% growth. So that's pretty good. And I think you have to go all the way back to my first slide when I talked about the selected market returns, which is that most asset classes have given us no return this year. And last year, if you remember, 22 didn't give us a lot of return. So if we have earnings growth, that means the market's getting cheaper. And that means that you can easily see a big snapback. I think probably more importantly is some of the future earnings growth. These are FactSet, and they update these pretty much every week. And so again, still very positive follow through. So if these bars, simply put, come true, when I'm standing up here a year from now, the market will do very well. Because you will have follow through in the market if you've got this kind of earnings growth, which we have not had. All right, well, I will end with, first off, what we're a real-time trade we're making inside portfolios, and then I'll do a quick recap and then invite Anna to come back up and introduce our keynote speaker. Again, as I mentioned, for all the Altair clients in the room, in the taxable fixed income portion of your portfolio, we've been rolling short-term treasuries. We started with 6-month, we moved to 3-month. And over this last few months, last few quarters, now what's happened is, I mentioned, the long end of the treasury curve, I'm looking at the 7-year treasury, has spiked up. And so now these are becoming very attractive to us. And so we are just at the beginning phase of moving client portfolios or recommending client portfolios move from the shorter term treasuries into this 7-year treasury. Because for really 2 reasons. One, just the absolute return of 4.5 to 5% for taxable fixed income is historically very good and not one we've seen in many, many years. The second reason is where we are in the Fed rate hike cycle. So I have the last 6 rate hike cycles on this, call it spaghetti chart here. And what you can see is that when the Fed does their final rate hike, these charts are of course easy to make in hindsight because you know when the Fed is done, but you don't always know when the Fed's done when you're looking forward. What you can see is when they're done raising rates, some of these spaghetti lines, rates keep coming up for a little while, but if you look at all 6 cases, 12 months out, rates are lower, and sometimes materially lower. 2006 is kind of in the same spot, but more or less, when the Fed is done raising rates at the end of this of a rate hike cycle, rates fall. So in our mind, that says I'd like to capture today's rates, that 4, 5, 4, 6. If you get one of these spaghetti lines that comes way down the rates, that means we'll get 2 components to the return. We'll get our income, that 4, 5, 4, 6, and we'll also get capital gain appreciation. So that is sort of real time of what we're doing. And some of you have already caught wind of that in our materials. So let me recap, and then I'll invite Anna back up to introduce our keynote speaker and kind of dive off the deep end into the artificial intelligence topics for today. So first off, really the market has been driven by the Magnificent Seven so far. That's where really all of the return is coming, especially in the large cap market. Hamas's attack of Israel certainly has raised global risk, but the reality is those kind of conflicts, geopolitical conflicts, longer term, 6 months out, do not really impact the S&P 500. The Fed has been rising rates. You saw it on the front end of the curve, and now finally that long end of the curve is starting to catch up. Inflation is starting to slow, but it's certainly been gradual and bumpy. And the consumer has really powered this economy. And so we're keeping an eye on those. What does higher for longer, the higher interest rates for longer, how does that impact the consumer? So certainly something we're concerned about both on the business side and the consumer side. And then finally, a real-time opportunity that we're taking advantage of in portfolios, starting to migrate from short-term treasuries to longer-term treasuries.